Hey, welcome back. So, last time we dug into how individual companies show us they're healthy, with dividends and buybacks. But what happens when you zoom out, like way out? How do you check the health of an entire country? How do you give a whole economy a report card? Well, today, that's exactly what we're going to figure out.
Right. This is the big question, isn't it? We hear it on the news constantly. The economy's up, the economy's down. But what are they really looking at? How can we, for ourselves, tell if things are booming or if we're maybe heading for a bit of a slowdown?
The answer almost always boils down to these three little letters GDP. This is the big one. It's the headline number for a country's entire economic engine, and we're about to crack the code on what it means and how you can actually use it to understand what's going on. Okay, so first things first. Before we can talk about growth or those ups and downs, we have to get our heads around what this thing, GDP, really is. The simplest way to think about it, it's like a country's total annual paycheck. It's the grand total price tag on absolutely everything. Every coffee, every car, every new building, made inside a country's borders over a year or a quarter. It's the ultimate economic report card. All right, that definition is fine, but theory can be a little dry. So let's make this super simple. Let's imagine our own tiny little economy. We'll call it Explainerville. So, in its very first year of existence, let's say all the businesses in Explainerville produce a grand total of $10,000 worth of stuff. That number, 10 grand, that's its GDP for year one. Simple enough, right? But here's the thing. A single number, all by itself, doesn't really tell you much of a story. And this is where it starts to get really interesting, because a single GDP number is just one snapshot in time. The real magic, the real insight, comes from watching how that number changes. Is the whole economic pie actually getting bigger, or is it shrinking? So, in year two, everyone in Explainerville works a little harder, they're a bit more innovative, and their GDP goes up to $10,500. Now that looks like good news, right? But hold on. Here's the crucial question. Did they actually make more stuff, or did the price of everything just go up? This is the massive difference between what we call nominal GDP, that raw number, and real GDP, which is adjusted for inflation. So let's assume this jump to 10.5 is because they really did produce more. That $500 increase works out to a 5% real growth rate. That is the number you hear about on the news. It tells us the real speed and direction of the economy. But you probably know where this is going. There's always a catch. I mean, wouldn't it be nice if the economy just grew at a steady 5% every single year forever? Of course. But reality, as we all know, is a lot bumpier. Economies have good years and bad years. They have moods. In fact, you could even say they have seasons. And these bumps, these ups and downs, they actually form a pattern. Economists have a fancy name for it, the business cycle. But honestly, the best way to think about it is as the four seasons of the economy. It all starts with expansion. That's your economic spring and summer. GDP is growing, people are hiring, and things feel pretty good. Then you hit the peak, that perfect sunny day at the height of summer. After that, things cool off. That's the contraction, or autumn. Growth slows down and things might feel a little uncertain. If it gets bad enough, we call it a recession. And finally, you have the trough. That's the dead of winter, the bottom of the cycle, right before a new spring of expansion starts all over again. Okay, so that's the big picture. But how do you use this in real life? Well, I'm going to give you a super simple checklist to run through every single time you see a GDP number pop up in the news. It's just three questions. First, what's the real growth rate after inflation? Is that number positive or negative? That tells you if the pie is getting bigger or smaller. And second, based on that, you can ask, which economic season are we probably in? Are things heating up in an expansion or cooling down in a contraction? This little framework completely changes how you see that headline number.
So, if you take away nothing else from all this, let's just boil it down to the three most important ideas you need to remember.
Number one, GDP is the report card, but it's the real inflation-adjusted GDP that's the actual grade. Number two, economic growth is never, ever a straight line. It's a cycle of ups and downs. And number three, every single cycle has those four seasons we talked about: expansion, peak, contraction, and trough. And this really is the key. Once you understand this pattern, you're not just listening to the news anymore. You can start looking for the clues yourself. What's happening with hiring, with spending? What hints are out there that might tell you which economic season is just around the corner? And understanding these seasons is so important because each one has a massive effect on our next big topic, inflation. We're going to tackle that one next time. I really hope this helped make sense of it all. And hey, make sure you subscribe so you don't miss what's coming next.